Okay, good afternoon. We will start the lecture. Today we are going to discuss about intangibles, how to account for intangibles. Basically, we have the learning outcomes for that. You know, we will be studying the key characteristic of an intangible assets, explain the criteria relating to the intangible recognition of intangible assets, explain how to measure intangible subsequent to initial recognition, then explain the accounting for disposal of intangible assets, applying the disclosure requirement for LKS 30. Basically, we are covering these areas under these standards, and this standard applicable for intangible is LKS 38. This standard is particularly the intangible accounting for intangible assets much more similar to accounting for property, plant, equipment. There is no there is no big difference between accounting for PPE and accounting for intangibles, but only the difference is the nature of the assets. First, so thereby you may talk about the cost revaluation model, and you may talk about the instead of depreciation here we are talking about amortization and also derecognition. So we will look at first the meaning of intangible. It's basically an identifiable non-monetary assets without physical substance. What is important is when you say intangible, you can't touch it. So thereby we call it, physical. There is no physical substance. You can't see it. You can't touch it. So thereby intangibles, the opposite of tangible is intangible. But we can say an identifiable, non-monetary assets. So you can identify uh, it with your entity, or you can identify it with reference to a particular agreement. So thereby you can sell it separately, the intangibles, like selling a machines, all that. Okay, the key characteristics very clear, I think. Non-monetary, identifiable, lack of physical substance. Then we will move on to the next slide. Of course, the nature of intangible assets. We are trying to understand the monetary and non-monetary story. When you say monetary assets, of course, monetary assets are, money held and assets to be received in fixed or determinable amounts of money. Purpose is to exclude financial assets. Here, when you look at the non-monetary in nature, so the amounts or the whatever the amount is, if it is fixed or determinable, we call it really monetary. The opposite of monetary is non-monetary. So thereby non-monetary assets value, or the what is to be received in respect of the particular assets is not fixed. It will vary. It's not possible to determine something like that. So the purpose of such identification as non-monetary is to exclude financial assets such as receivable from date, trade receivable, loan, etc. So this particular area, that means the financial assets will be discussed under SLFRS 9. Financial instruments, the relevant standard for financial assets. So basically, when you look at the financial assets, it's an identifiable non-monetary assets, with lack of physical substance. What an example? You can give an example. A goodwill, patent, copyright, trademark, franchises. So those are franchising agreements. All those are, coming under the intangible. But when you look back about 20 years, 30 years ago, intangible was not really much more significant. Look at the nowadays, today's business context. Even it's not relevant to the my computer related, but even manufacturing, service, whatever the type of organization, intangibles are important. But for certain cases, certain specific industry, intangible may be much more significant, like Google, IT related, technology related businesses. Intangibles may be much more important. But what I'm trying to say you is that whether it is manufacturing or non-manufacturing, whether service oriented or manufacturing oriented, intangible has its own value. It has an impact on corporate value. It has an impact on share price. It has an impact on capacity to generate, future cash flows. So I have taken this from another way of looking at monetary and non-monetary. Example, trade receivable, trade payable, pensions. Here the example, property, plant, and inventory, some repayments. Non-monetary items, monetary items. But here, monetary items you can put under even paid and all that. No. So basically, assets can be classified into monetary and non-monetary. When you look at this side, you see that amount is fixed by certain amount. Here, the amount is not fixed. For example, inventory, you are trying to add the cost of whichever is low. We don't know. Sometimes our inventory will get outdated, so the other value will be zero. Okay, right. Then for an intangible to identifiable, one of the following two criteria. So I think you can remember the criteria of intangible: identifiable, non-monetary, and without or the physical substance. No physical substance. When you look at the first one, identify, it's separable from the entity. It's separable from the entity. It is capable of being sold, rented, licensed, transferred. You can separate it from the entity, and also it arises from contractual or some other legal rights. For example, trade license, patent. Where there is a contractual or legal right, it needs not it need not to be separable or vices. No need of satisfying both. But when you say identifiable, it has two components: separable and the legal or the contractual obligations or contractual agreement. LKS 38 requires the assets to be non-physical. The conceptual framework financial reporting specifically says, when you say financial assets, what do you call this? The assets, as per the conceptual framework, no need to be physical, physical forms. It may have physical and non-physical, tangible and intangible. It covers both as per the conceptual framework. Then LKS 30 contains no discussion of this character. It focuses on control. Control, usually system from legal and other rights, can be difficult to establish. What is important is that your ownership is not important. What is important is the controllability of the assets. Highly trained staff, maybe well-trained staff, scientists, experts. Even though we have such employees, we don't have the control. So thereby, not qualify intangible. We don't have the control over those employees. So thereby, you can't consider them as, recognize them as intangible assets, expert in your organization, employees, human resources. Criteria for recognition and initial measurements. When you look at the criteria, of course, much more important. Recognition means you are inserting any financial elements of financial statements into the into the financial statement is called recognition. Inserting, it's a kind of process. You are inserting a transaction or event or element of financial statements into the financial statement, assets, liabilities, income, expenses. If you are trying to insert into the financial statement, it's called recognition. As for the conceptual framework, basically, there are two general criteria for recognizing of an assets with regard to the, old conceptual framework. Those two are probable it is probable that the future economic benefits attributed to assets will flow to the entity, and the cost of the assets can be measured reliably. So those are based on the old 2010 conceptual framework. But you know that there is a revised 2018 one. So there are, assets recognition criteria in general is, talking about uh, relevance and faithful representation. You should ensure, if you can ensure the relevance and faithful representation, you can recognize any assets in the financial statement as per the new conceptual framework. But since this particular standard is developed uh, under the old conceptual framework, so thereby recognition criteria in general applicable in relation to the old conceptual frame. But remember, when you study accounting standards, financial accounting, both old and the new, both the conceptual frameworks are important, because old standards are based on old conceptual framework. If we are getting a new standards after 2000, I think effective date is 2020. So after that, if you are getting any new standards in Sri Lanka, a new conceptual framework is applicable. Anyway, a general criteria is that probable future economic benefits will flow to the business, and also costs can be reliably measured. Intangibles are required to be initially measured at cost, similar to LK's property, plant, and equipment. Basically, intangibles required to be initially, generally at cost as per plant and equipment, property, plant, equipment. The cost includes the purchase price plus the any directly attributable cost bringing the assets to the usable condition. No. Okay. So basically, there are four type of I would say four sources of intangibles. Four ways of intangibles, analyzing four ways. One is, separately acquired or separate acquisition. Third one is acquisition by a part of business combination, acquisition by way of government grants, and internally generated, uh, intangibles. Separate acquisition, acquisition by business combination, just because of government grant, or internally. Internal means internal firm, you yourself, your organization develop. For example, if you are developing your own software system, so it's a internally generated. Any tangible, any assets you can generate internally. There's no problem. We'll discuss one by one. Separate acquisition, of course, recognition. LKS 38 considered that probability of recognition criteria is always considered to be satisfied for separately acquired intangibles. We assume that both the condition general criteria can be satisfied, and cost can usually be measured reliably. The cost means the cost plus, as I told you, cost purchase price plus the directly attributable cost. Then, of course, second one, acquisition in business combination. When you acquire any intangible and business combination story, SLFRS 3, remember that you are not measuring the intangible initially at cost. Remember, you are measuring it at fair value, not at cost. That's the difference. Is it clear? Business combination, you just acquire a business. When you acquire business, you may purchase goodwill, you may purchase any brand name, whatever intangibles. So then you what you have to do is you brought in them to the fair value. So how do you take the fair value? Of course, for that, study the fair value accounting standard. This is not time for me to explain what the fair value is. But anyway, there are three ways of measuring fair value as per case 38. Quoted market price, you go to the active market and get the price. That should be your price. Recent transactions in the same or similar item. If there is no active market, you can take the recent transaction in the same or similar items. Other one is using other methods. For example, you can use the present value technique. So thereby you can take the quoted price or the market price. You can find out a similar item price if market price is not available, or you can go to the present value or the income earning multiple techniques. So to value the particular intangible. Now I would like to highlight one thing. When you recognize any assets, basically as per the standards, whatever the standard, there are two things. At the inception, at the initially the measurement, we call it initial measurements. That means at the time you enter the journal entry time, when such a assets incurred, that's called initial measurement at the inception. So as we explained that if you purchase a particular intangible, suppose you are buying a patent, a software for 5 years, something like that. You are buying a security system for your machine, for your network, for your system for 5 years, for 50 years, then of course it's coming under the intangible. So what you have to do is initial measurement is when you acquired separately its cost, but if it is a business combination, you have to remember initial recognitions at fair value. Then recognition of acquisition via government grants. Of course, government will really give us certain cases, certain facilities, certain intangibles for us to develop the business with the expectation of getting the total benefits to the country and the people in the country. So thereby, acquisitions via government grants also we can talk about the intangible. Some intangible assets are allocated to entities via government. Of course, example, television station operating license, maybe radio station operating license here. So those are government grants. If that is the case, we are not dealing with under case 38. If it is related to government grants, we do it under, we account for under LKS 20, accounting for government grants, disclosure of government assistance. So it's a separate standard. Anyway, then internally generated intangibles. Internal means we ourselves, rather than going out and buy, we ourselves generate. The issue at what point recognize an assets from the start when success is imminent. So when you take internally, what points you are going to start, basically. That is the most important case. Now, with regard this, of course, you see, I would like to put your attention, basically. There are three stages. One is the, you see, research phase. We can say research. The next one is the development. Third one is commercialization. So, basically, what you can do here is, with regard to the internally goodwill, there are three phases: research, development, and commercialization. So we will look at these three sources. Determine comments capitalized cost depends on whether the assets was generated in the research and development phase. So then we will look at what is research, what is development, what is commercial. Research means you carry out a research, we call it scientific or the original plan investigation to gain understanding or knowledge about something. So maybe you just want to study particular system, particular process, or ways of doing it. You just want to computerize your system to develop particular software. So likewise, when you have any problem, when you are going to make a solution for that problem, of course, you need to collect data. You have to understand what it is, the research through empirical evidence. So thereby, research is basically you undertake research. It's kind of investigation with the intention of gaining or taking or understanding or knowledge about a particular incident. The search for new knowledge, search for alternative processes, accounting treatment, all research costs are expense. So what I want to communicate here is that whatever the cost incurred in during this research phase, any cost, maybe you spend research 3 years. So if 3 years, here 2 million, here 4 million, here again 3 million, year 1, year 2, year 3, whatever the cost you incurred under the research when you are trying to develop the internal intangible by performing a research, all these items P&L, not the balance sheet. In the year it was incurred, so this 2 million will be charged to P&L in the first year. This 4 million would be charged to P&L in the second year. This 3 million would be charged to P&L in the third year, 3 million. So double entry would be you are crediting the cash, debiting the research expense. Here also crediting cash, debiting the P&L, whatever. I think it's clear. Okay, then we will look at the other one. What is the other one? Other one is development stage. You see, development stage. Development stage. Here, development. So development is not like that. Development is little bit advanced. And when you reach the development stage, you have certain expectation. You have certain expectation that product will work. The simple example, due to COVID pandemic 19, you see that lot of pharmaceutical organization, they carried out research to find out to develop a vaccine, to develop a medicine. So they did research. So all the research activities, you cost incurred P&L, no argument, whatever the cost, whether it's have a big impact on P&L profit. Big impact means just because of research cost, your profit may become negative, loss. It doesn't matter. So once you have the understanding about the development, you may develop the project, you may develop the product, you may develop the process, you may develop the system, you may improve the system, you may increase the capacity of the system, you may, try to develop something based on that understanding. Even that, if you take, it may take periods. We'll assume that only 3 years. So suppose here you incurred 5 million development cost. Here you incurred 6 million. Here you incurred 4 million. So what is the other things? So just by looking as per the standards, we can't just tell the treatment. We need to understand the nature of the development cost. Nature of the development cost. Just give me a little bit time to explain what it is. For development cost to be capitalized, the entity must meet all the following criteria. But in research, we didn't follow any, evaluation. We didn't look at the criteria. We just look at If it is a research, of course, you can transfer it to the P&L, charge it to the P&L. But if it is a development cost, you have to look at certain criteria. What are those certain criteria? Criteria are, of course, technical feasibility. Technically, you should be in a position to produce the product. If you are producing a vaccine, you need to have the enough the scientist, the technical feasibility, initial intention to complete and sell. You should have a intention, objective, purpose to complete the project and make it, market it. Then ability to use and sell. You should be in a position to sell it, use it, maybe for your own purpose, use it. And existence of a market, and also availability of resources and ability to measure cost reliability. If all these six criteria are satisfied, what you can do is you can really capitalize this 5 million which was incurred in the first year of the development stage, and we can really what do you call capitalize this 6 million also in the second year. So what would happen? Capital account, you always credit whatever the things cash or payable 5 and 6, and you debit the development cost or the work in progress. So now at the end of the second year, you will have a 11 million, because previous period you had 5 million, this million 6 million. And when the development completes, you will end up with 15 million in your account, development accounts. That's the idea. So how can you capitalize it? There are 6 criteria. What are those 6 criteria? Feasibility, technical feasibility, intention to complete and sell it, ability to use or sell it. There should be a market, existence of a market. You should have enough other resources or the resources availability, and ability to measure cost reliability. That's okay. So then, of course, at the end of this thing, your account will have 15 million as 15 million cumulative, because 5 year first year, second year capitalized this much, third year. So you will end up with the development cost 15 million. And once you complete the development, now you have to go to the market. That is called commercialization. That is called commercialization. Of course, if the commercialization, if you expect to really operate 5 years, you can calculate the amortization as 15 divided by 5. So then what happens is here 3, 2, 3, 4, 1, 2, 3, 4, 5. So and then each year your depreciation or the accumulated amortization, each year amortization cost would be what you call 3 million. That's all. 3 million each. If the particular development or the intangible is for a particular period, we call it definite. There are certain goodwill, certain intangibles which have definite period. Then of course you are not amortizing, like depreciating land. Anyway, shall we go to the next? I think that's about this thing. I have to clear it, otherwise where is clear? Yeah, clear. What happened is internal generated intangible assets, the following are excluded from recognition. Even internally generated goodwill, we are excluded from LKS. Internally generated goodwill, brand names, meta, masthead, publishing titles, customers. These intangible can be recognized at their fair value when acquired as separate of a business domain. Even though you have intangibles internally generated, these type of internally generated assets we are not recognizing. There should be specific part. No internal name, no internal master, no internal publishing title, no internal customers. Is it clear? Okay. What we do is now, uh, again, this Google, the example, Microsoft, Facebook, Samsung, Disney, and those are the example of brands. All right. Then we have the, you know, section example, a list of items that could be accounted for as intangible assets by Dory Limited. There are 5. Cost of purchasing a trademark. When you acquire a particular trademark, of course, you have to credit the cash or debit the trademark account by the cost. Cost include not only the purchase consideration you paid, but also additional other professional charges, legal fees, etc. Goodwill acquired in the purchase of a business. Again, of course, since it's acquired goodwill, you have to recognize it in the balance sheet to the fair value. Cost of developing a patent, of course, cost of developing a patent, we can't say it is to be capitalized. So we are asking whether the 6 criteria are satisfied. But the 6 criteria: technical feasibility, intention to complete the project or sell the product, marketability or market feasibility, available resources, costs can be measured, reliability, etc. Those are the 6 criteria if you want to capitalize any development cost. In this case also, if those 6 conditions are satisfied, of course you can capitalize the patent cost. Cost of engineering activity to advance the design of a product to the manufacturing stage, again, it's increasing the productivity. Of course, you can consider it as intangible. If uh, I mentioned earlier, part 3, just see whether the criteria are satisfied. If the criteria is satisfied, of course, you can capitalize. Deposits with an advertising agency for advertisement to increase the goodwill of the company. When you look at here, the outcome is uncertain, and we don't know whether the advertisement will be successful or not. And advertising agency is much more independent. They are developing their uh, advertising. For us, that is true, but so thereby uncertainty involved. So thereby we can't capitalize or counted for as intangible the fifth. Okay. Then with this, of course, today's session will over. Thank you very much for being with me. So I will stop sharing.